Hi, Steve here. Welcome to the special recording on trading diagnosis, where we have taken some of the trades that you were nice enough to send in for us to analyze. And the goal here is, we have to realize that the market that we look at probably are not the ones you're going to be trading or have traded. But from an educational perspective, I think you'll get a lot out of this short session to see how we look at trades, what was done right in our opinion, what was done incorrectly. And this is really part of our series of free educational things we do from time to time. As you know, we do market updates, we do trading diagnosis, and other aspects to help you, in addition to the things we offer as an investment for those who want to go more in depth, that we do at no cost to our Candlecharts.com family. So anyway, let's look at the first one. Okay, here's a trade we actually did at Candlecharts.com. Now we all obviously use the candle charts, Tracy, Sil, Paul, and myself. So here's one of the trades that actually Tracy did, and she went long at the bullish engulfing pattern over here. Here, let me just make it a little bigger so we can see it. Okay, over here, bullish engulfing pattern. And the stop was below the recent low, which was over here. And another, beside the bullish engulfing pattern, obviously we have, I shouldn't say obviously, but there's a rising window. So notice how the low here held that the bottom of the rising window. And whenever we do a trade, we have a price target and a stop at level. So as I just mentioned, the stop was under the recent low over here, and the price target were the highs here. So what Tracy did was took some profits as we got to the highs here. And because there were really no bearish candlestick signals, she's still riding half the position. Now notice here we had a doji, but a doji, remember, doesn't turn the trend from up to down. It turns it from up to neutral. So something like this, if before getting nervous, we wait for a lower close, which did not occur. So that's a good reason to stay on the long position. Just because you have a doji, as I just mentioned, maybe you can think about taking some profits, but that is not a reason really to get out or to be particularly bearish unless we get a bearish candlestick signal after that. Now notice we had a dark cloud cover over here, but there's also a rising window. So this bearish dark cloud cover really would not be confirmed until the market broke under the support level of the rising window. Okay, on this one, on June 13th, which was this day here, the trader went long, and his rationale was it held the bottom of the Bollinger Band. And in addition, here we had, this is a little bit more advanced, but this is a bullish counterattack. So here the market gapped down on the opening and then rallied to close unchanged from the prior close. Now, we know about a piercing pattern that goes more than halfway into the black real body, but that is more of a reversal signal. But this is the first sign that the bears were losing control. And then notice how the market held support at the prior lows. So he waited for a little bit of a breakout, went long here. He had a good risk reward. Okay, his stop was under the lows here, and his target, okay, was 217.85, so around $218. So he didn't give a reason why, but I'm thinking he was looking at the change of polarity. And let me do this. Okay, see how prior support, once market closed under, becomes potential resistance. So notice the hammer, by the way. Market rallied from the hammer. Okay, this would have been a nice trade also. You had a hammer confirming. Here's a classic piercing pattern that I just referred to before. This would be a nice trade also. You have the hammer confirming a support level. But anyway, once the market broke under the hammer, it changed the polarity. So he reached his target. So this is a nice trade. You had a couple of things going on. You had a successful test here, minor test of the lows. You had the market oversold, the bottom end of the Bollinger Band. And target, again, target is very subjective, but that would have been my target also, the prior support becoming potential resistance. So he reached the target, made a nice profit. Okay, now we'll look at a Forex market, the Australian dollar. Let me just move this down a little bit here. Or the Swiss franc. And one of the things that is great about Forex, for those who trade Forex, as you know, is it's very easy to short. And for those who don't trade Forex, something to think about if you like trading the bear side very easily because we know many times the markets can move down a lot faster than they can move up. So anyway, the trader actually went short on August 10th, and the trader had mentioned the shooting star confirmed a resistance area. Again, the idea of a candlestick signal confirming support or resistance. And the trader looked at stochastics. I don't have it on here, but he did also because of stochastics. Keep in mind, whatever your favorite Western signals are, use them in addition to candlesticks, because the more things you have coinciding, the more likely the reversal will take place. So here we had a shooting star. Also, this is, and I'll point this out, the trader didn't point this out, but this is also a falling off the roof. Resistance, resistance, resistance. The market poked above resistance. As soon as it got back below the resistance area, that's a crack falling off the roof. And the target is normally the recent low, which would have been down here. However, the trader exited on August 17th. Didn't give a particular reason why. Nice trade, because what's great about this is a really tight stop. If you're selling it on the shooting star here, right around a little above 75, your stop could be right above the high of the shooting star. And again, my target would have been here. So the way I personally would have traded, this is waited until we got closer to this target, and notice that we had the hammer and then the bullish engulfing pattern. So either on the hammer or the bullish engulfing pattern is when I probably would have been out. I would have definitely taken some profits on the way down. Nothing wrong with locking in some profits, so you're playing with the market's money. But I'm not sure. Maybe he was looking, or the trader was looking at an intraday chart and saw something on the 17th that gave him pause or to be nervous about being short. But nice trade, very valid in my opinion. Reason to be on the short side. The shooting star confirmed resistance, and again, as I mentioned, another reason is that the falling off the roof. Okay, here the trader went long on August 16th, which is over here. And the reason for that is he noticed that there was a little bit of an uptrend, higher lows, and it's a little bit of an uptrend. And he said on the 15th, so he went long on the 16th on this doji session here. So a little uptrend here, and you notice that the bulls shown they had taken control on the 15th. This is not a hammer, by the way, because the hammer should come after a downtrend. This is a classic hammer like this. See how it came after a downtrend? But he's right in so far, he or she is right in saying the bulls are in control in this session because the market opened here, sold off, and then closed there. So that's a plus. But let me ask you, what do you think he did wrong by going long over here? And what you could do is put the player control on pause and think about it. And by the way, he did get stopped out on a little bit of a correction. Okay, in my opinion, what he did wrong, if you're buying it here, okay, if my stop out was over here, he had a tighter stop. My stop would have been under the low here. So let me draw that. And my target would have been over here, the dark cloud cover. So if you're buying it here and your stop is over here, so here the risk reward would have been 1-to-1. So in my opinion, that really would not have been a great trade to take over here. What I'd probably do is wait maybe for a correction closer to the bottom end here, and from there, this way, if you're buying it here, your stop is under here. It's a much tighter stop. Notice this pattern here is a bearhotomy. Market broke out and had a bearhotomy. This is also a falling off the roof because the market got above resistance and then got back under it. So the target is actually down here as of now. So from an educational perspective, the trader was right. A little positive candle here, a little bull channel over the last 3 or 4 days. But because of the risk reward on this session over here of the doji, I would have stood aside. Okay, here on the oil services, this was actually back in 2015 when the trader did the trade and bought on November 3rd of 15, and a very valid reason, in my opinion, to be buying there. Notice the market broke above resistance. Relatively tall white candle. Let me try to make this line again here. There we go. Resistance line, the high here and the high here. Many of you should recognize this as a classic evening star pattern. But anyway, so the market broke above resistance, and its target, not sure how he got it, was about $40, and gave himself a lot of room on the downside. His stop was below here, right around $29. So let's see the risk reward. So his target was about $8 higher, and his risk was about $3. So, since he had such a high target, the risk reward was okay. Actually, he did and again, I apologize for your lady traders, but I just normally refer to, rather than saying he or she, I'll just say he. He did a call, a long call, and obviously with that you had time working against you. And with that in mind, although the stop out level, may have been okay because of the high price target, and obviously because of the fact that options don't move one for one with the underlying contract, doesn't mean you're really risking $3. It depends on the underlying option. But I just want to bring out a couple things. One, candlesticks are great for option trading, and two, how I may have adjusted the trade a little earlier. So over here, because the market got under here, he was stopped out. But what happened here? So the market got above resistance. What would get me nervous here? And we just talked about this in the last market. And again, you can put your player control and pause, and then hear the answer. Right, it's a falling off the roof. The market broke above resistance. This old resistance area should then become support. The market not only got under it, but closed under this. So with the idea, especially with an option trade, that you have time working against you, we want to get out of the trade as early as possible if we find out it's not working in our favor. So here is where I certainly would have considered reassessing my long position. Now we do have a small rising window here. So as long as the rising window is holding, I still would stay net long in the option. But notice the close here got under the rising window. So with the break of support here, now remember also with the falling off the roof, what's our target? The most recent low, and look at where the market went to. So the risk reward was fine for this trader. The breakout, buying on the breakout on a relatively tall white candle was good, but I would have gotten out of the trade a lot earlier rather than waiting for a break under the low over here. These were definitely warning signals: the falling off the roof and the close under the rising window. Okay, with this one, he actually bought a put, another option trade, okay, right around 108, and the reason he did it's on this session over here, right here. So the reason he did it was because of the falling window, which was fine. However, why would one think about being bearish on this session here, even with the falling window? What's the danger of going short on this session? Now, obviously, we don't know what happened after. Okay, again, put the player control on pause. Right, as of now, on this session, the market held the support level. This is not quite a hammer because the lower shadow is not twice the height of the real body, but it is a long lower shadow. So yes, it's bearish here because of the falling window, but you're buying at support. So it depends on somebody's trading style. I personally would rather wait for a break of the support to confirm that the market is going to continue lower. And look what happened in the next session. The market stalled at the window, which is a positive for a bearish trade. And it also, in my opinion, more importantly, made a new low close and broke under the support area. So I personally would prefer to be short on this session here. Yes, getting, I have to pay, I'm getting a little bit less in profit potential because I'm shorting at a lower level, but I've also decreased the risk of the trade. And he actually got out on September on this session here. Not sure why. Let me see if there's any support or resistance. Yeah. nothing wrong with taking a profit, but he didn't give a reason for why he got out here. The way I would look at it, I would still be in it, and I would have gotten out in this session here. This is a bull sash pattern. The market gapped higher on the opening and then closed on the high of the session. But there's really no signals on this session here that the bears are losing control. But nonetheless, the main thrust of this particular trade from an educational perspective is if you're selling, I prefer not to sell at a support level, even though you have a bearish falling window. Okay, on Home Depot, again, another trade from 2015. Went long on the 19th, which was on this session here. And he was actually looking at earnings. The earnings were good. And he also noticed, in my opinion correctly, the market held above a resistance area. See, it closed above resistance there and continued to hold above it over here. And okay, and his target was right around here, around the 135 level, and you could see why. Actually, we'll under 134, right around over there. And actually, so that was his target. So his actual target, actually, I'm looking at it now at 135. So I'm not sure where he got the target from, but let's look at this from a perspective here. So that his target was 135, which is right over here. Let me draw this line again so we can see the breakout. Okay, so here's where he bought. So his target was 135. So we have to do what I call being a market chameleon. Remember, we had a breakout before in one of the other markets I looked at, and it broke above resistance. Then we had a falling off the roof, and based on that, we had to adapt our market stance. Same thing here. The target is 135, but look at what's going on here, right around the 133.5 area. A doji, a bearish engulfing pattern, a dark cloud cover, another doji. So even if the trader had a target here of 135, it certainly would make a lot of sense to view this resistance, which was confirmed by candlestick signal after candlestick signal. He had plenty of time to get out. This should have been a time to get out. It doesn't. I don't know if he did or not, but we have to. Although we have a target, if the market is telling us something different, we have to listen to the market's message. Okay, and I hope he got out. If he waited to 135, this is what would have happened. Okay, here's another trade, Qualcomm from 2015, November 4th. So let's look at that. All right, so bearish engulfing pattern at resistance. So once again, just echoing the importance of having a candlestick signal confirming a support or resistance area. Many of you should recognize this, right? What is this? Shooting star. And look at this bearish engulfing pattern. Look how many times bigger this black candle is compared to this small white candle. You have a bearish engulfing pattern here, and he actually, I'm sure, I would guess news came out, something like this. So he actually exited the next day. But the point is, he did exactly right that the candlestick signal confirmed a resistance area. He actually did a put option, and that's a great trade because if the market goes down, okay, we know implied volatility really spikes faster than it does if the market rallies. So we exited on the next session. Now, if this was news related, if this was expected news, personally, I would rather be standing aside. If this was surprise news, that's something different. But if an earnings report was coming out or something that was anticipated as far as news, yes, we have a bearish engulfing pattern confirming a resistance area. But if the news had come out as particularly bullish and the market rallied, he could have been under a lot of water. Again, doing a put is not as bad as dangerous as going short if the market goes against you. But nonetheless, the idea, if you're expecting news to come out, I'd rather stand aside and see how the market reacts to the news. But barring that, the way he did it, candle signal confirming resistance, great trade idea. And based on that, on this, he actually exited at 52.81, which was right around over here. Okay, but with this sell-off during the session, okay, my target would have been down here at this support area, which we exceeded. Okay, again, another trade from 2015. And it doesn't matter when the trade was done. We're using this as an educational process. So here he did the trade on September 30th, right around the 108 area, a little above 108. And the reason he gave was the market had broken out of a bull flag. So let me show you. For those not familiar with a flag, you have a rally. So the market, yeah, I'm going to make an arrow actually. So the market moves up and then goes counter trend, moves down, and in a kind of in a parallel way. See, it's like a bear channel here. And when the market closes above the top of the bear channel, and I'll draw the channel. Okay, so ignore all this stuff over here. So here's the bear channel. So once the market got above the bear channel is when he went long, which it makes perfect sense. And he actually, his target was, and he exited at around 118 using the highs right around here. So that was a good trade. Now, because he did the trade as soon as it broke out here on an intraday basis, it worked out okay from a risk reward because if you're buying it here, okay, right around the 108 level, your risk is down here and your target is here. However, if one waited to the close of the session, then that would be a trade one should stand away from because you would have bought here, your risk is here, and your target is here. That is a poor risk reward. Now, it's interesting, speaking of bull flag, for those of you familiar with the measuring technique of a bull flag, and for those who are not, just kind of I'll go over what it is. So you take the height of the flagpole. So in this case, it's from, let's say, from 93 to about 117. So that's $24. And then once the market breaks out of the flagpole, the flag portion, you add 24 to the correction low over here, which is around 104. So your target actually is right around 128. And interestingly, we got right to that target. Okay, and we started to get some warning signals, a long upper shadow, a doji over here. So just to show you that we could and should use classic Western measuring techniques even on a candle chart. So we give up nothing by using a candlestick chart because we have the same data as a bar chart: open, high, low, and close. Okay, and GoPro went long right around $55 on July 15th, which is over here. So he did it because of the rising window. Now, here we have a little bit of a dark cloud cover, but on this session, notice we had the successful test of the rising window on the next session over here when he went long, so that's a plus. Also, I would have viewed this as this prior resistance area over here to over here. See, multi-tested resistance as support. So we had to stop under the rising window, and his target was recent highs over here on this dark cloud cover. So nice risk reward. I think the trade was valid. Nice tight stop, and good risk reward. All right, on the S&P on July 8th, he went long a call. So let's look at July 8th over here. Right around the 2060 area, so right over here. And the reason we did that is, and this is something we actually look at with one of our trading strategies, if you have a hammer, this is not a classic hammer, the lower shadow should be twice the height of the real body, but a lot of times you have a long lower shadow, the market will get halfway into it or a little bit more, and then as long as it holds a low, it's a potentially good buying opportunity. So he bought it when the market got halfway into the lower shadow, had a protective stop under the low here. And he didn't have a target. He likes to see how the market reacts rather than having a potential target. So he exited at around 21.19, so I'm guessing right around here. So nice trade. And let's say that we wanted to wait for bearish candlestick signal. So say you go long here, you went long a call here. the first true sign of a reversal. Here we have a bearhotomy, but the market's still hovering near the prior high session, so I wouldn't have got nervous. Here's where I would have started getting nervous. You have a doji, and normally a doji by itself is not a reason for that much caution. But what is this doji confirming? Again, put the player control on pause. And the answer is a major resistance area. All right, and then the fact the market was stalling the next session with a high wave candle, then almost a bearish engulfing pattern, but the doji would have been the first sign of caution. Okay, here's a trade that Paul did, and he did it on this hourly chart, and we had a bullish engulfing pattern, but even before that, once the market broke under, see the support area here? Once it got under it, and as soon as it got it back above it, that is a crack and snap. And your minimum target is the most recent high, which was around 44, which was around 40. Paul's target actually was more up here, with the high is over the little spike high over here, right around the $44. And the initial stop was under the $37 area. So as the market rallied, he moved up his protective stop. He used a trailing stop. And then based on the daily chart, and let me look at that. Okay, as we were getting some smaller real bodies and close to the resistance area is where he locked in the profits at $43.20 on August 24th. And since we had some option trades that we discussed, let me show you a trade I did a little while ago with the idea of one, using candles for options, and two, we could also use candles for breakouts. Most of the things I've been analyzing today have been reversals, looking for the trend to go from up to down or from down to up. But let me show you I could use breakouts also. So here within our Nison candle scanner, that is our software that will automatically recognize my 14 most bullish and 14 most bearish candlestick signals and highlight them in any market of your choice in any time frame. So here we got a couple of the signals within Nison candle scanner, the shooting star, bearish engulfing pattern, and so forth, the doji over here. And I was longer term bullish on this, and so I was waiting for a breakout. So what happens is these candlestick signals can be used as resistance. So if the market closes above this resistance area, we know then based on the change of polarity, old resistance should become support. So what I actually did was went long a call on the breakout over here, had a protective stop under the change of polarity, and because this was a long call position, we have time value working against us, so this was timed as a short-term trade. All I was doing was looking for a target, minimum target. We have this falling window here, and the whole window is resistance, so the minimum target is the bottom of the window over here, and the major resistance would be up here. But the fact the market stalled here for many weeks gave me this as a comfortable target rather than over here. And the market got to the target. I exited on the bearish engulfing pattern. So made a nice high percentage return on a very short-term trade. So the idea here, again, is you can use candlesticks not only to trade reversals, but also to trade breakouts. So thanks for joining me. And before we finish, I just want to give you a special thank you bonus for spending time with me. And up until this Sunday, August 28th, if you put in GIFT, G-I-F-T, you have a special code, and you're going to be able to get $25 off of any new order of $100 or more within Candlechartsacademy.com. So thanks again, and look over all the resources you have in Candlecharts Academy, and look forward to working with you as we continue our path down the road of candlestick education.